Hi everyone, this is John Robertson. I am the author of The Value of Simple, a practical guide to taking the complexity out of investing, as well as the Practical Index Investing for Canadians course, which you can find at valueofsimple.ca and course.valueofsimple.ca. This is a recording of my simple investing presentation that I gave for the Toronto Public Library a couple of times in 2019. I know that there were a couple of people that couldn't make it out that really wanted to see this, and I said I would eventually get around to recording it and putting it on YouTube, and here we are. I will just quickly note that this is not a flashy YouTube presentation. There aren't going to be sound effects or green screen. It's just my voice over slides. So hopefully that will work for all of you. And I'll just make a note to check the doobly-doo or that information down below the video, where I'm going to put some various links as we go through, including a link to the handout that I created for people who came to the talk in person in Toronto. So an important first step before we get started is understanding a little bit about financial literacy, and I'll make an analogy here to food literacy. So here's an ad that came up into my Facebook feed just before Halloween from Wonder. A mummy pizza. It was spooktacular according to the ad. And what it is a slice of Wonder bread with some tomato sauce on it and a couple of strips of what they call white cheese and then 2 little olives for eyes. And you got to ask yourself, like, is this pizza? And I guess, like, technically maybe it is. It's got some sort of bread base and then some sort of tomato sauce and some sort of cheese topping. So if you were to go and say, hey, this is false advertising, that's not pizza, they might say, well, technically, I guess it is sort of pizza. So with food literacy, you know that this is not really pizza, or at least it's bad pizza. And you would not go and try to buy this at full price at a pizzeria, and you would not make this and give it to your kids and call it pizza to them, because everyone knows that's not going to be good pizza. But the same thing is happening with all kinds of other advertisements, including with the financial industry. So if you don't have good financial literacy, if you don't really know the difference between what's technically an investment that's suitable for you and one that's actually good for you, and what the difference is between something that's like some sort of monstrous combination of bread, tomato sauce, and cheese. And what makes this even worse is that they mentioned that you could put ketchup down instead of tomato sauce, which is even further from real pizza. So if you understand that that is bad pizza and you understand what makes a bad investment, then even if you don't want to do it yourself, you can at least find someone that's going to make you a good pizza or a good financial investment in this case. So you need to have some sort of understanding of financial literacy to know when someone is trying to pass off some Wonder Bread with cheese on it for full price as being a bad deal. So we'll start with a quick little story that you've probably heard before of the grasshopper and the ant. The grasshopper went along, saved all its little bits of food through the summer. The grasshopper fiddled. Winter came. The grasshopper died in the cold or was given food by the gracious ant, depending on how grisly the version of the fairy tale you've heard is. And this is used as a metaphor for retirement. You need to go ahead and save something for the coming winter, for the coming time when you won't be able to work, when you won't be able to harvest, so that you have something to get by on. And this is a good enough fable for what it is, save for the future. The problem with this fable is that it breaks down when we're talking about the real world, because you can't just save for retirement. If this ant is going through and trying to save up for future years, every piece of food that ant puts in her little anthill that she wants to eat later, she has to put in the hard way. So if she wants to eat one piece of food next year in the middle of winter, she has to put that one piece of food in the anthill. The food doesn't grow and multiply as she's going. That means she needs to have a pretty high savings rate. If she's only got 6 months of the year to be gathering food, and then another 6 months of the year where she's got to live off her stores, she needs to gather 2 pieces of food for every piece that she wants to eat at that time. And that's what we get if we're trying to retire without investing. Every dollar you want to spend, you have to save first if all you're doing is saving. That leads to a very high savings rate. And if we look at our lifespan, if we're saying, okay, the first number of years, you're just sort of going through university and school and getting started with your family and whatever, and you don't really start to power save until you're in your 30s, well then if you want to retire at the typical 65, that only gives you 30 years of savings. And then if you want to retire at 65 and plan to live up to 95, that's another 30 years of living in retirement. So those are pretty much equal time frames, and if all you're doing is saving, you need to save $1 at your 30s to be able to spend $1 in your 60s. It leads to a very high savings rate. So if you've heard that, oh, save 10% of your income as like a very general rule of thumb that people throw around without really justifying it, but if you've heard of these kinds of savings rates, the only way that that works is if you have growth from investing. So there, with investing, with time, your future dollars come from the growth of what you're saving now. So if you go and you save $10 now, it's got 30 years to grow. That becomes $50 later. You save another $10 the next year, it's got time to grow, it becomes $50 later. In this very simple sort of demonstration here. And so that gives you a lot more leeway to be able to live your life a little bit better now and not have to save quite as much in order to meet your retirement goals. Of course, that leads to the big question, how do I invest? Because it's great to say that you really should be investing, but how do you do it? And that's what the bulk of this presentation is going to be about. So there's 3 basic ways to get investing. You can pay someone to do it for you, and there's a couple of ways to do that. You can do it in a very transparent way, or what we call fee only, and that's where you pay someone to manage your money, and then you see the bill very transparently. So you say, I've got $500,000 I want to invest. They'll charge you 1% of those assets, which leads to a fee of $5,000 a year. And then they go and invest that for you. This generally is a model that only is available for people with large accounts. People who work on a fee-only basis tend to have fairly large minimum sizes to take your investments. The other way to do it is with hidden costs, where you get quote-unquote free advice, which is paid for by a mutual fund company or a bank or whatever. This is very common if you go into your local bank branch or a large mutual fund company and want to invest. And they don't necessarily tell you that you're going to be paying costs, that the funds that they will put you into are going to be what's paying for them. It looks like it's free. You walk into your local bank branch and you say, I've got some money to invest. It's RRSP season. Help me get invested. And they go, sure, and then help you get invested, but then it ends up costing you a fair bit. And Canada actually has some of the highest mutual fund fees in the world, and fees do matter. So if you don't want to pay someone to do it for you, your other options are to do it yourself or find some sort of hybrid model where you pay for some sort of advice but then do some of it yourself. Now there is a bit of an advice gap in Canada. If you have lots of money, there are advisors falling all over themselves to help serve you. They are looking for those high net worth investors. They will do their jobs on a very transparent basis where there's an understanding between both parties of what they're doing. They try to remove as many conflicts of interest as possible. But there aren't a lot of great options for those with more modest means. I mean, there's no shortage of sales staff. If you walk into your bank branch, even with only a few $1,000s to invest, there will be someone there who's ready to help serve you. But they're mostly going to be trying to put you into whatever mutual fund that they have, and it's likely going to be high fee. There's going to be a huge focus on whatever product they have to sell you. If you go to an insurance salesperson who touts himself as a financial advisor, they're going to focus mostly on your insurance needs because that's what they have to sell you, and they won't necessarily talk too much about your debt. Same thing if you go to a bank branch where they have mutual funds to put you into, they're going to be very focused on what mutual funds you can put your money into and what they can sell you in that way, and not necessarily on whether or not you have a will or have insurance. And you always have to question whether or not you're going to get value for money because these things have high embedded fees, so the fees that you don't necessarily see with the products that they're selling you. Those mutual funds, those insurance policies, they have pretty high embedded fees. And are you getting good value for money when you go to someone who's mostly interested in selling you one of those? Are you getting a good plan? Do you have confidence that you're moving towards retirement? Are they holding your hand through the market fluctuations? And if you're not, then your other option is to basically try to do this yourself. So when we're talking about planning, when we're talking about advisors, there's a lot of stuff that goes in toward having a successful financial life. There's the aspect of budgeting and living within your means, and that ties into things like cash flow and savings, having an emergency fund, having insurance to disaster-proof your life. Then you need to plan. Do you have clarity on what your plan is, why you want to go to where you want to go? what your goal is and what the trade-offs you have to make are. If you want to retire earlier, that means you have to save more. If you want to take less risk with your investing, that means that you need to save more or be prepared to spend less in retirement. What are your plans and trade-offs? Have you discussed this with your advisor or decided upon it yourself? And then finally, you need your long-term savings to help meet those goals, which is going to involve investment products, what tax shelters to put them in, as well as some tax reporting and some optimization to do. And all of these are kind of needed in some sort of balance, kind of like I had them in this figure. But in the financial industry, these things get skewed because they don't really have products for planning so much. They don't really have products for cash flow or short-term savings except for bank accounts. And so then the focus tends to be more on what they can sell you, which are a big focus on insurance, not so much on emergency funds, a big focus on investment products because that's where there are lots of fees to be had and lots of products that advisors can sell you, as well as on those tax shelters that those investments can go into, but not so much necessarily on then optimizing your tax situation, dealing with that, et cetera, et cetera. And so in a hybrid model, we try to break that apart so that there isn't so much of a focus on the products so that you can get the planning and the decision making that you need. So you want to pay for advice that you need, and you want to do that in a very transparent way. So one way that I'm a big fan of is to pay for that by the hour or by the project. So you say, I want a financial plan, you go to a planner, and they will deal with whatever aspect of your plan that you need help with. Whether that's going to be your cash flow situation, how to budget your family, how to deal with your existing debt if that's the case, or it might be something that would be more amenable to a product focus like how should I invest? But you can still do it in a very transparent way on an hourly basis. And you focus on what you need. So the keywords to look for are fee for service, advice only, etc. And I actually have a directory of fee for service planners available, and I'll put a link down below. And then with the hybrid model, after you get that plan going, you then handle the investments on your own or separate from the advisor or the planner who is helping you to come up with that plan and helping you to decide on that direction for your financial life. And one way to handle that separately is with something called a robo-advisor, which you may have heard of, and if not, we'll talk about that in a couple minutes. So the do-it-yourself investing environment, or DIY, is getting better and better and has continued to get better, especially over the last few decades. There are much simpler options. You don't have to go out and pick a whole bunch of individual stocks to try to invest in. You can find something, including all-in-one products now, that make it a lot easier to get started. The fees are a lot lower to be a do-it-yourself investor, which of course makes it easier to get in and makes the case for doing it on your own a lot better. And there are better books, courses, and other resources out there. Of course, talking about my own resources included in there, the Value Simple, the Practical Index Investing course, so that there's a lot of hand-holding now if you want to get started to be able to find the step-by-step way of doing that. And there are more a la carte options for help. You don't have to have a single relationship with a broker or advisor, whatever you used to have to do in our parents' generation. Now there are a lot of options for help where if you just need a plan, you don't have to then give this person your money to manage forever in order to get access to that plan. You can just pay for the plan and then manage your money yourself. Or you can pay a much lower fee to have one firm manage your money and a fee to another one to produce your plan, or you can do the plan yourself, whatever combination you want to do. And of course, if you need help with other aspects that weren't covered by traditional planning, such as budgeting and cash flow for your existing household, there are now people like money coaches that can help you with that aspect too. So then when we talk about investments, what are investments? What are we doing? So with investments, we're taking our money and we're buying something that we're hoping is going to give us a return in the future that's going to be greater than if we had just stuck our money in a savings account. Although savings accounts are one aspect of investing. So the big one that we usually talk about are investing in businesses. So this is also called stocks or equities. That's where you own a portion of a business. So if you take a very big business, you can divide the ownership up amongst hundreds or thousands or millions of people into millions of different shares, and then each person can buy a small share of that business. Then if the business does well, they make a little bit of that money. If the business does poorly, their investment might do poorly. And this is our riskier stuff, or our growth stuff. So we expect usually businesses on the whole, not necessarily every single business, but businesses in general, are going to make money for their investors, and they're going to continue to grow into the future. Of course, that is risky. You've probably heard that the stock market contains risk, and we definitely want you to walk away from this presentation knowing that there is risk involved in investing. You're also going to have some of your safer stuff where there's interest that you make. So you loan out some money and you expect to get a fixed rate of interest coming back, as well as the money that you gave out in the first place coming back. And that can be in something as simple as a savings account, or a GIC, or guaranteed investment security, or a certificate, or in a bond, which is similar to a GIC but given to a company where you, or a government, where you give a certain amount of money to, or you buy a certain bond with a certain price, and then you expect to get a certain interest rate back. This is our safer stuff. Now, this is not totally 100% safe anyway. For instance, if interest rates change, bond prices can change. You can lose money in bonds, but you're likely to lose less than you would investing in stocks, at least over the short term, and they're less volatile too. And they all generate returns in different ways. Bonds and GICs pay interest payments. Companies can pay dividends, or their value can grow, which gives you capital gains. And there can be a few other ways of generating income too. So a very handy invention to help make investing easier is something called a mutual fund. This is a collection of stocks or bonds, or both stocks and bonds, and it makes it so that you don't have to go out and pick a bunch of individual companies to invest in. You don't have to find all of those stocks to buy. You don't have to go to all that work. It's going to give you the advantage of scale and ease of use and diversification. So diversification here means that you're going to spread your money across a large number of companies and even across different economies, so Canada's economy, the US economy, the world economy, to help spread out the risk of investing your money. And mutual funds have a subset of mutual funds called exchange traded funds. So these are essentially mutual funds that trade over a stock exchange, and you buy and sell them like a stock. The advantage to these is that they typically have lower fees than the mutual funds. And the fee to watch out for is usually expressed as an MER, or management expense ratio, and this is expressed as a percentage. So if you buy a mutual fund, you're going to have to pay a fee every single year of how much is invested into that mutual fund, and that fee is going to be given in the disclosure documents, and the keyword you want to look for when you're looking for that is MER. So there are lots and lots of stocks and bonds out there, lots and lots of individual companies, and they can go up, they can go down, and sometimes one will be up one day, one will be down in one day. And indexes were created to help newspapers answer the question of, how's the market day, or how's the average stock doing? And so they started by taking a couple of different companies and averaging their stock price together. And that way they could say if one was up and one was down, on average, the market was up or down on a given day. Makes a nice little newspaper headline, makes a nice little article, and then people can sort of talk about stocks in aggregate. And as it turns out, lots of mutual fund managers can't outperform the index that they track net of fees, which leads us to this whole idea of index investing, where we just want to be investing in the index. We just want to take our money and spread it out, because that's the principle that we're trying to follow, is get our money invested for growth for the long term and diversify, and the index is a great way to do that. And there are a number of indexes out there, and they're grouped into what we call asset classes, or different kinds of investments that we can invest in. So one is Canadian bonds, and you may have heard of a bond fund that you might want to invest in. And it usually tracks something like the Universe Bond Index, as the index of a number of different Canadian government and Canadian company bonds to track. For Canadian stocks, there is a index called the S&P TSX Composite Index, as well as other similar indices. For U.S. stocks, there's a number that you might have heard of. The S&P 500 and the Dow Jones Industrial Index, or the Dow sometimes is all it's called, feature prominently in the news every night to see how the market as a whole is doing. You may have also heard of a total U.S. market fund, which then tracks thousands of U.S. companies. And then finally, there's international stocks, and a common index abbreviation is the EAFE, or Europe, Australia, and Far East Index, that covers the developed markets overseas. So as I was hinting at the last slide, you can compare the performance of a mutual fund that is trying to pick a selection of stocks or bonds to throw within it, to an appropriate index. And it turns out that most mutual funds underperform their index net of fees. Now, if a mutual fund is going to underperform its index net of fees, why bother paying those fees and going with that mutual fund? A great idea is to just buy the index, and that's led to this whole rise of index investing, which is what we're going to be talking about in terms of how to actually get investing here. And the idea is that you just buy the whole index and try to keep your costs as low as possible, because costs do matter. And that gives us those core principles of investing that we're trying to meet. We get that growth, that long-term potential for growth that we want, as well as diversification. We're spreading our money across hundreds or thousands of companies around the world in a very simple and easy to do way with index investing. Now, before we get too far into how to go about buying an index fund, we need to talk briefly about products versus accounts, or fruits versus baskets, if you think of it. So accounts are like the baskets, the things that hold the products. So our accounts are our non-registered accounts, or a taxable account. And this is a definition by exclusion, basically. If it's not one of the other registered accounts, it's a non-registered account. So if you're investing in a non-registered account, or a taxable account, that's a big mouthful, but it's basically just a regular account. If you make any money in that account, you then have to pay tax on those gains. And a non-registered account can include things like your regular checking account where your paycheck goes into and then you pay money out of. That's just a regular account. It's not a special tax shelter. And if you make interest on that, you're supposed to be reporting that interest on your tax return to the government. Same with a regular savings account. Then you can also have tax-advantaged accounts like a TFSA, or tax-free savings account, an RRSP, or registered retirement savings plan, RESP, registered education savings plan, and there's a few others that are less common. RDSP, they're a RIF, that we're not going to talk about. And then the products that you put into there, that can include mutual funds, GICs, cash, ETFs, which are a kind of mutual fund that trades over a stock exchange, as well as individual stocks and bonds. And yes, cash in this concept counts as a product. If you have a regular checking account, that's a non-registered account. Cash goes into that. That's the product that goes into the account. If you have a TFSA at a brokerage account, you can hold exchange-traded funds or mutual funds inside of there, and then they get to grow tax-free. So one of the most common that people are more familiar with is the RRSP. The way the RRSP works is that you put in pre-tax money. So that is money that you haven't paid tax on yet. Now most people don't have pre-tax money sitting around. They usually have tax taken off their paycheck. So then what happens is you put money into your RRSP and then you get a deduction that you put onto your tax return. And that means that you get some of the tax that you already paid back. That's what helps give you that tax refund at the end of the year after you file, when you put the money in. But when we try to compare and think about RSPs, it's helpful to try to think about the money that's being in the RSP as pre-tax, because then you have to pay tax on the withdrawal when you take the money back out. Everyone has their own individual limit for their RSP. They get a certain amount based on how much they earn, subject to certain corrections and adjustments. For instance, if you have a defined benefit pension, you're going to get less RSP room. If you make a whole lot of money, you're going to be capped at how much RSP room you can generate in a year, etc. Anything that's inside the RSP is growing tax-free. So your investments grow tax-free, and that's the main benefit of putting your money into the RSP. Then when you withdraw, the withdrawals are taxed as income, and you lose the contribution room. There's a few other little minor things, such as if you live to 71, your RSP then has to convert to what's called an RRIF, or Registered Retirement Income Fund, where there's a forced withdrawal schedule. So you have to start withdrawing from your RSP at a certain point. And there's a little bit of tax arbitrage to do here. What we mean by that is that in addition to the benefit where your investments grow tax-free, if you're contributing at a high tax rate, you're putting in pre-tax money, so you're not getting taxed on that money as it goes in. You're paying tax when it comes out. But if you're paying tax when it comes out at a lower tax rate, then you get an extra benefit to having your money in an RSP. Of course, that can work against you too. If you put in money when you're in a very low rate of tax and when you're not earning very much money, and then in retirement you're taking the money out, or whenever you take the money out, again, there's no limit. Just because it's called a retirement savings plan doesn't mean that you have to take it out during retirement. You can take it out at any point. It's just you have to pay tax on it then. If if you take it out while you're still working and you're making higher income, and so then you're in a higher tax bracket, you're going to pay more tax on that withdrawal. And so then that can work against you, that little bit of tax arbitrage. And there's a limited ability to withdraw without paying any tax or losing the room through programs such as the Home Buyers Plan or the Lifelong Learning Plan. And you can search for HBP or LLP if those might apply to you. The TFSA is a newer account that is a lot simpler than an RSP. Everyone gets the same contribution room every year. So now it's $6,000 of additional room that you get, and any room that you've earned up to this point you get to also use. As soon as the money goes in, that's the contribution, and then once the money's inside, it gets to grow tax-free as much as it wants. You don't need to worry about the contribution room once it goes in. It's just how much money is sort of coming in through the door. The money goes in tax. It's money that you've already paid tax on, but it goes in. You don't need to worry about it going in other than the contribution room. There's no deduction or anything else to report on your taxes. Whatever you invest in within the TFSA gets to grow tax-free, so you don't have to pay taxes on the investments as they're growing. That helps them grow a little bit faster. And then anything that comes out tax-free. And it's a little bit more flexible than the RSP because you get the contribution room back if you have to withdraw. However much you withdraw, you get that amount as contribution room the following calendar year. So you do eventually get it back. So that if you need to invest in if you invest in the TFSA planning for the long term, but then something comes up and you need to withdraw, you can withdraw and you'll get the room back. And only the in and the out, what you're putting in and taking out of the TFSA counts towards your contribution room. What happens inside is treated as kind of like a black box. You don't need to worry about that affecting your contribution room. If you lose all your money, you don't get more contribution room. The contribution room was used when the money went in, even if you pick a bad investment. If your investment grows, it doubles, triples, quadruples, whatever, that then doesn't mean you have to start pulling something out because you're going to run a contribution room. That growth inside the TFSA does not affect your contribution room. And of course, there's a bit of an unending debate between the RSP or the TFSA. Which one's better? Which one's the best? Especially around RSP contribution time in February, you'll see these articles coming out almost like clockwork in all of the national newspapers. The core thing to remember is that both of them allow for tax-free growth over the long term. The tax refund issue with the RSP muddies the comparisons, and some people do make mistakes on this. It also has some implications for means-tested clawbacks. So for instance, if you're going to get OAS or GIS in retirement, these are both plans where you're getting money from the government, they have means-tested clawbacks so that if you're taking more out of your RSP, that counts as income, and then that means that you might lose some of your GIS or OAS payments. The TFSA does not have that issue. Of course, flexibility cuts both ways. The TFSA is wonderful because you can use it for long-term savings and investing, but then if something comes up, you do have the ability to take it out without having to face a big tax hit in the year that you take it out, and you get the room back so you don't have to worry about losing your contribution room forever. But that cuts both ways. For some people, it's better to have the RSP having that penalty to take money out in terms of having to pay the tax and lose the contribution room, because then that helps them stick to their long-term plan. My very simple rule of thumb is fill your TFSA first. People generally have less TFSA room than RSP room. TFSAs are generally better for people that have lower income than higher income. And even for people with higher income, TFSAs are not bad. So fill your TFSA first. If you're earning more, having a higher savings rate, you're probably going to then fill your TFSA, use up all your contribution room, and then have to move on to using your RSP anyway, which will work out fine. If you're lower income, where the RSP really isn't a good idea for you anyway, you'll start using your TFSA room first, and then that'll be it. You might not even fill your TFSA. And so then that's a really good, in my mind, rule of thumb. Fill your TFSA first. For more, I have a decision guide handout that I'll put the link into the bottom, or you can see the link here on the screen. Okay, so we've talked about the baskets now, the TFSAs, the RSPs, as well as the taxable accounts that you might be sticking your investments into. So now what do we put in them? Well, we could buy individual stocks or bonds, but this is not a great option. You need a lot of different stocks and bonds to be diversified, because if you put it all into one company, turns out that company goes out of business or whatever, you lose all of your investment. So mutual funds are a great alternative where they're going to hold a collection of stocks and bonds to give you that diversification. The issue with mutual funds is that some have high fees, but there are many low-fee passive index funds, so funds that are just going to track those various indices and be very passive otherwise. And of course, you can also use exchange-traded funds, which there are some that are actively managed, but a number of them are passive index funds as well that have fairly low fees, and then you just have to figure out how to buy them over the stock exchange. Now, of course, when we're talking about that active versus passive following the index or not, remember, net of fees, passive index funds beat the average active funds. Now, that means that some active funds will outperform, and of course, if you look in the marketing literature of any fund company, they're going to pick the ones that did happen to outperform, but most of them don't. So if we look at the most recent report that I had available, the 2018 SPIVA Canada year-end report, we found that only 10% of Canadian, 9% of international focused funds, and 4% of US focused funds managed to outperform their benchmark for the 5 years ended 2018. So even if they managed to outperform for a year or two, outperforming for 5 years is rather unlikely. And there's no reliable way to pick the 10% or so of active funds that will outperform in advance. And that's the key thing. It's easy after they've already outperformed to pick the one that outperformed, stick it into the marketing brochure and say, hey, look, we have this fund that outperformed the index. But it's very hard for you as an investor to pick out which is the next fund that's going to outperform in the next 5 years. And it turns out that fees are the most dependable predictor of performance. This is a quote from a Morningstar Fund Investor article. And lots of other research backs this up. You want to be picking low-fee funds because the funds are directly counting against your returns. And there's no other reliable way to find something that's going to do any better than the index does. To try to demonstrate this more graphically, this is a figure from my book looking at simulated returns with different levels of fees, or MER as the measure of fees. So if you had no fees, you get the return of the index listed here in that dotted line. And the reason I put it in that faint dotted line is because the index is an imaginary construct. So there isn't such a thing yet as a completely zero fee investment available to Canadians. There's always going to be a little bit of a fee, although in the US we have started to see even a few no fee funds start to come out. Now, a typical fund in Canada might have a 2.5% MER, which is the fainter solid line on the bottom. And you can see how 2.5% doesn't sound like much. If you're only paying a 2.5% markup on, for instance, a car, you probably didn't do too bad in your negotiation with the dealership. But that's because you'd only be paying it once. Paying 2.5% of what you've got invested every single year starts to really add up. And you can see how over the course of an investment career here, over the course of 35 years, that's taking away about half of your potential return. That 2.5% doesn't sound like much, but it really does add up to a big impact over the longer term. Whereas if you had a fund that only charged 0.5%, which is totally doable to find, then you find that you manage to keep most of that return. And that's what I put into the bold there. And one final thing to note, you'll see this chart bounces around because it's based on real stock market data. Picking a low-fee fund does not get away from the fact that it is going to do that bouncing up and down. You will have market crashes from time to time, and you can't really avoid them. So really you need to understand that there is risk in investing. But that difference between the two lines, you totally can control in advance just by looking at what the fees that they're going to charge you are. Looking for low-fee products is going to help ensure that you are not going to be giving up half of your potential return over the course of several decades. So to help understand how these relatively small sounding percentages lead to very high bites in terms of your overall fee, I have a metric here called the MERXXX, which is the management expense ratio over 30 years. And of course I like it because 30 years is a typical time horizon for people to think about when they're investing. If you're starting in your 30s, and you might be thinking about until you reach retirement. If you're starting retirement, still some of your money is probably going to have to last you for 30 years because people's life expectancies are increasing and you might live well into your 90s. And I also like it because XXX sounds dirty and fees are dirty. And so that helps reinforce that idea that you need to really focus on the fees. Now, of course, the fee is paid every year out of the fund whether the fund goes up or not. So this is not a fee based on the performance. They're not taking 2.5% if you return 10. Even if the fund goes down, they're still taking that 2.5% if that's what you're invested in. And that compounds over time, which is why that effect becomes much bigger. It's why if you do the math and you think, oh, I'm doing 2.5%, why is it not adding up to a smaller bite than that? So here a chart compares a couple of investments that are available, and you can see what that 30-year impact is. So if you're paying 2.4%, which is what the data tells us the typical equity fund in Canada is paying, that's over half of your potential theoretical returns. Whereas if you're investing in some of these other things like a Vanguard all-in-one ETF, which is the second from the bottom, that's 0.24% MER. So that's 10 times lower cost. And that's only going to take about 7% of your total 30-year return. Losing up to half of your potential return, that starts to really affect how you're going to be able to retire, when you're going to be able to retire. Losing 7% of your theoretical return, again, part of that is that, well, you never could have got totally down to theoretical return because there's no such thing as a zero fee investment product. And also 7%, like you can budget around having 7% less money than you might have planned on. And so these lower fee options really become very good things to think about. Now, why don't you immediately always go for the lowest fee one? And that, well, that's because there are trade-offs, and we'll get to that in a sec. Basically, the top funds, there's a salesperson there to sell them to you. So not only do you not have to learn how to invest on your own, you can just walk into a bank branch and hand a check over and they just deal with it all. But you're paying a really big price for that convenience. The other ones, there's a little bit more convenience as you move up. So if you want to, for instance, invest in a 4 ETF portfolio, well, you have to learn how to invest in ETFs in the first place and then do a lot of the maintenance yourself. Paying a little bit more to have an all-in-one ETF means that they're going to do some of that for you. So in addition to talking about the importance of fees and how these index funds are the ones that tend to have the lowest fees available because you're not paying for all those managers to do all the research and try to pick all those stocks for you, another huge benefit of passive investing is that it's simple. You want to diversify your investing globally. You want to have a number of different asset classes that you're investing in, things like bonds, Canadian stocks, US stocks, international stocks. And that's about it then. Then you just have a few asset classes to get. Each of those has an index to track, so you're just buying a few different funds to invest in, and you don't need to do a ton of research. You find whatever fits you best in terms of cost versus convenience for the type of fund that you're going to buy, and then you just set it and forget it. The index fund research shows that you're not going to be changing up this idea of diversifying broadly year to year. So you don't need to worry about re-examining your entire investment philosophy depending on whatever new research is coming out in terms of individual companies or individual economic factors. You just know that over the long term, this is something that's going to generally work out. And so then you trust the research, you set it, and you forget it. And that's a very freeing mindset so that you can get your investing up and running and then not have to make it a second business for yourself or, force yourself to make it into a hobby. You can just solve your investing problem relatively easily. So in terms of those specific options that are focused on passive investing, here are 5 different choices that I generally recommend. Any one of them is going to work for people in general. Which one specifically will work for you is going to depend on your individual circumstances and what you want to do. So over on the left, we have ones that are simpler, but a little more costly. And then they move down through to the ones that are less expensive, but then getting more complex to manage. So for instance, Tangerine has all-in-one funds. It's very simple to use. You can invest to the very last penny. It's very easy to automate your purchases, very easy to set up automatic contributions, and they do automatic rebalancing. But they're charging you 1.07%. That's much better than the typical fund that someone will sell you at a bank branch. So it is still do-it-yourself investing. There's still savings to be had here, but a lot of the other options are even cheaper. Robo-advisors have come along recently, and they offer simple interfaces and easy automation and all those same benefits. They might even have a little bit of advice to be able to give you, but their underlying portfolios may be a little more complex, and some of them may stick you with some tax reporting to do if you're investing in a non-registered account, but that does come at a lower price than the Tangerine option. TDE series is a mutual fund, and it's the lowest cost mutual funds in Canada, which is why we're talking about them. You can invest to the last penny because they are regular mutual funds, and you can automate your purchases, so you can set up recurring contributions every month, every 2 weeks, depending on when you get paid. And the orders are pretty straightforward, but you have to manually rebalance them. So if you're buying different Canadian and US and international investments, each one of those is going to be a fund, and as their performance varies, you're going to have to be the one to do the work to make sure that it stays according to your investment plan. And of course, you're going to have to be buying multiple funds associated with that. And here I've got a bracket around a lower fee, and that's because TD recently announced some changes to their funds. That's not going to go into effect until later in 2019, but basically the proposal is to lower their fees by about 0.05%, so from 0.42% to about 0.37% or so for a typical balanced portfolio. And exactly what fee you're going to be paying here is going to depend on your specific mix of funds. Then you can move down to an all-in-one exchange-traded fund. So it's just one single thing to buy, but because you're talking about an exchange-traded fund, your orders are more complex to enter because you're having to buy over the stock exchange, and you have to invest in whole ETF units. You can't just invest to the last penny. Say I've got $111.16, throw it into an investment for me. Now you have to do a tiny bit of math to figure out how much you can buy of that ETF. And you have to make manual purchases. You can't automate your contributions and just have it automatically get invested every month. You're going to have your money going into your brokerage account, and then every month you'll have to log in and actually make that purchase yourself. And then finally, if you want to save a little bit more money, the lowest cost option is to use a portfolio of exchange-traded funds. So now you're having to deal with all that extra complexity of the all-in-one ETF, and instead of just having one ETF to buy, you're going to be buying several ETFs. And again, all of them work. All of them are going to get you your money invested. It's just how much work are you willing to put in versus how much convenience you're going to get back. And different people are going to see value at different points. Some people don't want to have to deal with entering their orders themselves, and they're going to really gravitate toward a robo-advisor or something Tangerine. Other people are unfazed by any of this complexity and going to go right to the lowest cost option on the other side, and other people will find themselves at some intermediate step. And you have to decide for yourself what's going to work and really reflect in terms of how much work you're going to be wanting putting in, not just right now when you're thinking about investing, when you're learning about it, when you're excited about it and watching a presentation like this, but also what are you going to be wanting to manage 5 years from now, 10 years from now. Try to really understand yourself and what you're going to be wanting to deal with. So to put those options in context, I've got them in the little green boxes here, and the little blue diamonds are some of the other options that are out there. So that's why I focus on these specific ones, because for each given level of complexity, they are the cheapest options. TDE series are the cheapest ones out there. That doesn't mean that the other banks don't have their own index funds that are cheaper than a typical mutual fund. It's just that they're a little bit more expensive than the TDE series, so why not just focus on the TDE series as long as they're all equally complex. Similarly, up at the other end, Tangerine's all-in-one funds are really easy to use. Their interface makes them really easy to use, and they're a little bit more expensive. There are other companies that offer all-in-one mutual funds. For instance, CIBC has an all-in-one index fund product as well, but it's just that little bit more expensive than Tangerine, and just their interface is a touch more complex to use too, so I also shifted it a little bit to the right. So that's why I focus on Tangerine rather than talking about all those other ones. Risk. Risk is, as you can see, a 4-letter word. So investing does involve risk, but the thing to keep in mind is that there's risk in everything. Just sometimes we stop paying attention to it. So GICs have risk. I mean, the G in GIC stands for Guaranteed Investment Certificate. So how do I mean that there's risk there? Well, risk comes on different time scales. So for a GIC, you are guaranteed to get a certain amount of money that you have put in plus interest, and that interest is guaranteed in the guaranteed investment certificate. So you're going to get that money back. The problem is the money that you get back will not necessarily buy the same stuff that you had been able to buy with the money that you put into it. If you have $100 and you can buy, say, 50 loaves of bread with that, you stick it into a GIC and earn 2% for a year, you get $102 back. But that $102, if bread goes up in price, might no longer buy 50 loaves of bread. You might only get 40 loaves of bread if bread prices really go up. So then your money might be losing value even if you're getting the same amount in dollars back. And so the risk there is, of course, inflation. In the short term, you don't tend to worry about inflation too much. If you have something that you know you're going to have to pay in a short number of years, for instance, if you've got a child who's 17 and going to university next year or the year after, and you know that they're going to have to pay a few $1,000s in tuition, you probably don't want to be taking risks with that in terms of having volatility in the return of investing that money in a stock market. You might want to be using a GIC for that kind of money. But if you have a 2-year-old, you don't know exactly how much tuition is going to be in another 16 or 17 years, and so then you might want to be investing money for their future education into something that has a little bit more potential for growth and to outperform inflation. Of course, the converse is that stocks have a very uncertain short-term future. You don't know when there could be a market crash. It could be right around the corner, it could be a couple of years from now. But if you need the money, for sure you need that money next year, you don't want to be putting that money into the stocks because they could go down in that short term. But over the very long term, the stocks are your best bet for trying to outpace inflation. You also want to be diversifying your risks. So if you put all of your money into any one of these options and the risk for that option really manifests itself, like inflation tends to spike up really high, or conversely stocks have a really bad couple of years, all of your money is going to be exposed to that. So you want to be diversifying away from individual risks that could sink your boat, basically. So you don't want to have all your money in stocks, you don't want to have all your money in GICs unless you have very specific reasons for doing that. And you want to make sure that you're diversifying within those. So particularly with stocks, you don't want to put all of your money into just one stock or even just one stock market. You want to be diversifying all around the world. Of course, there's also a danger of familiarity because we tend to not think about the risks of things that we're very familiar with and that we've already accepted. So we're very familiar with GICs, with having cash in the bank account, and so we don't think about the risk of inflation because we're kind of familiar with that, we become inured to it. But over a lifetime, when you're talking about money that you're not going to need for 3 or 4 or 5 decades, inflation could be a very big risk. An analogy I like to make is to think about flying. Everyone's heard about how safe flying is, but it can feel scary because it's unfamiliar. We don't go to the airport all that often or get into a plane all that often. It bounces, it shakes, and it goes way up high in the sky and goes way down low. It makes a whole bunch of noises. It sounds and feels and seems dangerous, but we know the statistics say that flying is the safer way to travel across the country. Whereas driving, we don't even think about it. We just get in the car, buckle our seatbelt, and go. And we don't think about the fact that so many people lose their lives driving. Driving is much riskier than flying. But it feels safer because we're, as we say, in control, even though you don't actually get to control everything. You have your hands on the steering wheel and your foot on the pedals, but then you don't control the driver that ran the red light and T-bones you through the intersection. So just because something is familiar and you've stopped thinking about the risk and you're not worried about the risk when you take it, doesn't necessarily mean that it's actually risk-free. And that applies here. Stocks are very unfamiliar and a lot of people are worried about investing in them, but just because it's unfamiliar doesn't mean that it's all that risky. There is risk in stock, don't get me wrong. I don't want anybody walking away from this presentation not understanding that there are risks involved in investing. But there's also risks involved in putting all of your money into cash and GICs and not taking that stock risk, because then you have that unfamiliar risk of long-term inflation. And even though the risk is very in your face with the volatility of stocks, it's still a risk that's worth taking. So your risk tolerance is going to really drive how you invest. So you need to think about your ability to take on risk. That's a huge part of your risk tolerance. What's your backup plan? how much flexibility do you have in your plans? What's your willingness to take on risk? What are your emotions? How much time do you have? And all of these things come into play. If you need the money very soon, then you can't really take as much risk because of the time factor. If you have a very robust backup plan or you're extremely flexible, then maybe you could take some more risk. And all of these things are going to come into play. And the risk tolerance is going to be the main driver of building your portfolio. If you're able to take more risk, you're probably going to have more of your portfolio into riskier things like stocks. And if you're not able to take as much risk, if you have less time, then you're probably not going to be putting them into stocks or even bonds. You might be looking more into GICs for your investments. So one example where all of these factors come into play is house down payment. For most people, that needs a short time because they're looking to buy a house usually within the next few years. And then maybe or maybe not, they have flexibility. In my case, I have my house down payment invested almost exclusively in stocks. Even though it is potentially a short time, I might hope to buy a house within the next 5 years and the stock market could correct within the next 5 years, I do have a lot of flexibility. So in my case, I have the willingness to take on that risk and also the flexibility. So if the stock market does crash as I'm preparing to buy a house, I can just not buy the house at that point and wait another 5 years. Or I also have other backup options. I can take the loss on the stocks and still buy a house. If I'm planning to put 20 or 30% as a down payment on my house and the stock market crashes, well, I can still put a 10 or 15% down payment on the house and still buy the house. So the stock market crashing is unfortunate. It means a loss of money, but it doesn't necessarily mean that I need to completely give up on my plan. I just have to be willing to take on that risk and willing to accept that potential loss. And so that's where all of these factors can kind of come into play. And if you're not totally sure, then you might want to lean toward being more conservative. So the short time period for a lot of people would be enough to just say, no, don't invest your down payment, put it just into lower risk types of investments. But for me, because I have the willingness and the flexibility and the backup plans, even though I have that short time frame, I'm still invested completely in stocks. Another example might be someone who's retiring soon. If they have a short time period until they're retiring, they have little flexibility in terms of adjusting their budget. They have a certain amount they have to spend on rent and on food and on medicine and whatnot, then they probably don't want to take too much risk there, especially if they don't have a backup plan, like if they can't work beyond a certain number of years. Then you have to be really thinking about what you're going to be using that money for. And of course, that might just be the first sort of bucket of money that you're spending in retirement, but then the money that you need 20 or 30 years later in retirement for the later phases of retirement, you might want to be investing a little more aggressively. Okay, we've talked about the products, the planning, the risk tolerance. So how are we going to build our basic portfolio? Well, first we're going to have some safer stuff, some fixed income, some bonds, and we're going to look at our plan and our risk tolerance. Now, if you don't really have a plan set up, maybe you want to use a quick rule of thumb. One I use is to take your age and subtract 10, and that's how much we're going to put into the safe stuff, quote unquote safe stuff, the less volatile stuff here. So if I'm 39, I'm going to take 10 off of that, that's 29. So I'm going to put 29% of my portfolio into the safe stuff. The rest I'm going to put into long-term growth stuff that is going to be a little more volatile and risky. So equities, and I'm going to diversify that globally into Canadian equities, US equities, and rest of the world equities. And I'm just going to split that roughly evenly. So I'm going to, if I have the other 71% of my portfolio, I'm just going to split that up into thirds and put a third of that 71% into each of those types of equities. And typically each of these options is a fund I can buy. So there's 4 funds, a safe bond fund and a Canadian equity fund, a US equity fund, and a rest of world equity fund. There's also some combination products, so all-in-one funds like the Tangerine funds or the all-in-one exchange-traded funds that are available now, so that I could just buy all 4 of these in one and then be set. So let's actually do this. So we've come up with a plan. We decided how much to save. We've made it automatic. We decided what our asset allocation is, how much risk we can take, how we want to split it. We decided on whether we're going to put our money into a TFSA or RRSP or non-registered account, and I'm using my rule of thumb of sticking my money into my TFSA first. Now we're going to put some products in. So the TDE series were a good compromise. They're kind of a halfway in that spectrum of cost versus complexity. And also, I don't have a personal conflict of interest there. I'm not a member of any kind of TD referral fund. They don't pay me anything. So that's a good, clean one to use where nobody's going to be worried that I'm getting any kind of money, because I am a member of the Quest Trade referral program. So let's go through a worked example with the TD series. First, we're going to go to TD Direct Investing, and we're going to create an account. I'm going to go to my checking account and make a bill payment to TD Direct Investing. That's how I'm going to get my money from my checking account to my investing account. It's going to take a few days for that money to show up. I'll go and wait 3 days, chill out, relax. Finally, the money shows up in my brokerage account, and now I'm ready to make a purchase. Now, this is a bit different than ordering a book on Amazon, but it's not so different, and this tends to be the point that I find a lot of people find investing gets really intimidating, is when you're actually having to go in and make that purchase. So let's look at it step by step. First, of course, I have to design my portfolio. So I've talked in general about how I'm going to split this up. 29% in bonds, the rest split roughly equally. Again, remember, this is just an example. This is just for me. You have to come up with your own plan based on your own risk tolerance and life goals and plans, etc. Feel free to talk to a planner advisor to get this set up for you. This presentation is not financial advice, yada, yada, yada. Now, each of these asset classes is going to have a fund code in TD. And so what I'm going to do is take however much I'm going to try to invest here, whether it's $5,000, $6,000, $500, you can invest with fairly small amounts of money too. And I'm going to split that up according to the weight. So if I had $100, I'd be looking to try to put $29 into the first category. If I had $1,000, it'd be $290 into the first category. And then you can do your own math from there, depending on how much you have. And so I'd fill out a table much like this to say how much I'm trying to put into each fund. And I would go and look up the fund codes for each of these funds that I want to be buying. And I've done that here for the TD E-Series funds for each of those 4 funds that I'm going to be buying. Then I log into my TD Direct Investing account, and up at the top it's got this menu bar, and I'm going to look for that buy sell button that I can see there, and I've circled it in red. I'm going to click on the buy sell button. That will bring up this screen here. There's a couple of things that I'm going to try to point to here. Look for my account. So if I'm buying inside my TFSA, I want my account here to say TFSA. And I can go over here to the drop down to select my different accounts. So I might have a non-registered account there, a TFSA, an RRSP, and I might have different versions of those for Canadian and US dollars. Now I'm only feeding Canadian dollars in here because that's what I get paid. So only the Canadian versions of my accounts have any money in them. So that's what I'm going to be buying in. And it'll say here that it's Canadian, and it'll have the little Canada flag drop down here. There's going to be 3 tabs in the order entry screen, and I'm going to be clicking on the mutual funds entry tab. Then I have an action. Am I buying or am I selling? Well, I'm going to be buying a fund, and then I have to enter the symbol or name. And I find the way to avoid mistakes the best is to enter the symbol rather than trying to enter the name, because TD has a ton of funds with very similar sounding names. Whereas if I enter the fund symbol, I know I'm going to get the TD E-Series, which is the one with the lower fees, and I won't end up with one that sounds very similar but ends up having higher fees. So I enter my fund symbol name, and then it pops up with that along with the name, so I can verify that I'm getting the correct fund that I want to buy here. Just to go on to the next step, once I've entered that, I have some information over here for the fund that I'm buying. So I can confirm that if I enter the fund symbol TDB 900, that is indeed the Canadian index fund, so the Canadian equities that I want to be buying. It gives me a price. I don't really care about what the price per unit is because I'm just going to be entering how much money I want to buy, and it gives me some other various information on the side here for that fund. And then I'm going to have a quantity. So how much of this fund do I want to buy? Am I buying it in dollar amount or units? So I could do the math and say, well, if this fund is currently trading at $23.90, I want to enter a number of units and do the math myself. I have zero interest in doing the math myself. So I'm going to enter dollar amount and put in the dollar amount that I've already calculated from that previous table. Then there's going to be some options at the bottom about including commission, etc. I hit preview order, enter my trading password, and go. And then I repeat this 4 times for each fund in my portfolio, my bonds, my Canadian equities, US equities, and international equities. And then that's it. I am a do-it-yourself investor now, and I have my portfolio started. So now you can be a do-it-yourself investor. All you have to do is create your plan, save some money, get that money invested, which includes creating that account and deciding your risk tolerance and purchasing your investing and all that, and then stay on track. But staying on track, this can be the big challenge. It sounds like getting started can be really challenging and the part that really trips people up. But getting started is not that bad. It requires, watching a video kind of like this, or doing some research, learning about how to get started, and actually then just getting started. But people can really trip themselves up with the staying on track because you have so many decades of staying on track ahead of you. And you have to go through that whole time without making big unforced errors, as Warren Buffett calls them, just little mistakes that can trip you up. You have to continue to stick to the same plan because switching your plans over and over can lead to a lot more problems than if you had just stuck with one good enough plan all along. And you have some work to do as you go along when you might have been losing some of the enthusiasm for investing that you had at the beginning when you were starting out. So first is rebalancing. So over time, your portfolio is going to change from your plan because the different parts are going to have different returns. If the US markets have a very good year while the Canadian markets don't, all of a sudden you're going to have more money in your US fund than you did in your Canadian fund because it managed to grow. And you want to be rebalancing back to your plan and your risk tolerance. And there's a couple ways to do that. The first is if your contributions are relatively large compared to your portfolio, you can do this just by buying more of what's underweight. If your contributions aren't large enough though, so if the swings in your portfolio are much larger than the amount of new money that you're adding to your portfolio, then you can sell what's become too large and buy what's down. And that's what this whole rebalancing thing is all about, because you're trying to make sure that you stay on your plan and stay to your risk tolerance. If you don't do this rebalancing and stocks keep going up and up faster than bonds go up, you end up having a portfolio that ends up having more and more stocks in it, which means you're going to be exposing yourself to risks that you didn't want to be taking in the first place. If you wanted an all stock portfolio, you should have just started there rather than letting it walk itself there on its own. In terms of how often to rebalance, you want to check about once a year to see if you need to rebalance. And there is no optimum frequency. Rebalancing every 4 months is not better than every year. And in fact, rebalancing every 2 years is perhaps just as good as rebalancing every year. Every year is pretty good though, because it's easy to set a calendar reminder or to have some sort of event to remind you. I myself like to do it in March because that is when I'm pulling out all of my statements to look at for tax purposes anyway. So it's a great time for me to then have all my statements out and in front of me and then decide what I need to do to rebalance. And it's also usually a pretty quiet time of year for me. Some people like to use, for instance, the New Year, but I find that Christmas time, New Year's time is just a crazy time. I don't have the time to go be looking through my statements and trying to rebalance. I find March works better for me, and you can find the time that works best for you, and then you can just go into your Google Calendar, for instance, and set a reminder to have come up just every year, just like reminding yourself about birthdays and anniversaries. And if you're looking for a tool to help with this rebalancing, there's a tool out there called Passive that works with ETFs and Questrade if that's what you're investing in. It won't help you with TDE series though. Then try to automate as much as you can, because the more you automate, the more likely you are to stick to your plan, because that's where people tend to fall down, is if they're trying to do things manually and then forget to or make a mistake. So for E-Series, you can set up recurring purchases with TD Direct Investing, but you can't do that for ETFs. And the way to get that is to set up 2 automated processes. So first you have to get the money into the account, and you can do that with either a pre-authorized debit by having TD Direct Investing pull the money out of your checking account, or you can do automatic bill payments from your checking account to push the money into TD Direct Investing. Then once you have that set up so you know when the money is going to be coming into your account, you call TD Direct Investing, and you do have to do this on the phone. There isn't a way to do it through the web interface yet. You call them to set up a pre-authorized purchase of a set of funds that fits your plan. So you're setting up basically 4 pre-authorized purchases, a certain amount every month to go into your Canadian index fund, a certain amount every month to go into your bond fund, etc., etc. And you generally want to set these up so that the purchases execute a few days after you have the money set to come into the account, so that there's room for error in case there's ever a delay in the funds coming in, that the purchase doesn't try to go through without having any money there. Finally, remember about simplicity. Simple is a good thing, and having simple investing, and again, that's the title of the whole presentation, makes it easy to stick to for the long term. And that's a big reason why I like index fund investing, not just because of the academic research that shows that it's more likely to succeed too. Remember that the big main pieces are going to determine your success. Are you saving enough? Are you investing intelligently? Are you sticking to it? Trying to optimize for smaller things can lead to a lot more complexity and not necessarily help drive your success. And it's very hard to actually internalize that message that simple is better, especially because a lot of the media that you might be reading tends to focus on the more complex, nuanced, smaller issues, because there's only so many times you can write an article that says save more, invest moderately intelligently, and then just stick to it for the long term and you'll be fine. And it's very hard to internalize that message. When I look at the questions that investors tend to ask me, that investors are asking on various message boards and to newspapers and whatnot, it seems that they're almost going out of their way to complicate things sometimes. And of course, complexity and effort feel more valuable and feel more important. And part of that is because investing is really weird this way. There's very few other things in life where things are cheap and easy and effective, and that's like the best solution to go for. And that's the case with investing. And it's very hard to realize that, you know, in a lot of ways, finding something that's cheap and easy and effective is very rare. Usually you have to put in more work to have something that's better, or pay more to have something that's better. And of course, we also really like stories. We are a storytelling species, and so it's very easy to say that some event in the news is going to drive the market and to try to predict things and to try to outsmart the index. And it's very, very hard to do. And so again, being simple and just sticking to the long-term plan is more likely to get you long-term success than trying to outsmart whatever the market gods are doing and trying to dance in and out of various positions or changing your weightings and whatnot to try to get a better return than that. So we talked a fair bit about passive index investing, about how the fees are important, the track record of active versus passive. Very few funds do manage to beat the market, and there's no way to pick those in advance. So these are all great reasons to be a passive investor. The other reason is the simplicity. So we talked about that, but another thing to keep in mind is execution risk. So how you're able to actually execute your plan. When you have a very complex plan, there's more room to screw it up. So even if the plan was really good and would have worked, if you make small errors in a very complex plan, you can end up having a very substantial underperformance relative to a simpler plan that's easier to execute. And this can be termed as the behavior gap with a very clever sketch from Carl Richards, where the investment return might be just fine, but the investor's return might lag substantially. The simpler your plan is, the easier it is to stick to, and the better you stick to it, the more likely you're going to get the returns of the investments. And if you look historically, investment returns have been just fine. All you need to do is match those, and you can probably make your plan work for you. So to control that behavior, again, we put that emphasis on keeping things simple. One of my big tips is to use your calendar. Put in notes if you're buying ETFs, when you need to go in and make those purchases. Put in notes to yourself every year to go and check on your investments and see when you need to rebalance. Put in notes for 5 years from now. Put in an appointment. Block off half a day to review your plan. Are you still saving enough? Remember that if you're using inflation-adjusted things, put in a reminder that when you expect to get your next raise, so that you can go and increase the amount that you're putting towards your automatic contributions. Because as your earnings increase, you're probably going to need to start saving more. As inflation happens, you're going to need to be saving more. You need to get comfortable, or at least comfortable-ish, with uncertainty and randomness. It is very comforting to see the guaranteed steady results of GICs, but they are very low. The returns from equities can be more volatile, can be scarier, but that's usually something that you have to just deal with and get used to. And the other thing is to check less often. Especially when people are starting out, they tend to check their portfolio every day. You're not going to do anything when you check it, so why are you checking it? And this is because also when you check your portfolio, people tend to get more stressed out by seeing the market performance go down, then they get happy by seeing it go up. So by seeing it go down, you're getting a bigger negative emotion than when you see it go up, you get a positive emotion. And unfortunately, if you're checking your portfolio every day, you've got almost a 50% chance that you're going to be happy and almost a 50% chance that you're going to be unhappy. The longer you leave it, the more likely it is that you're going to be happy checking your portfolio, because every day it's almost a coin flip in whether it's going to be up or down. But over the longer term, you get higher and higher likelihood that your portfolio is going to be up. And we can flip this around and look at it instead. Are you going to be stressed checking your portfolio? Well, again, you've got that almost coin flip chance of being stressed if you look at it on a day-to-day basis. And again, you're not going to do anything on a day-to-day basis. You're a passive investor investing for the long term. Whereas the longer you leave it, the less likely you're going to be stressed. If you're only checking in every quarter, which is every 3 months, or every year, you're much less likely to be seeing a negative number and to be stressed out when you check it. Now, of course, that continues into 5 years and 10-year periods historically. You don't necessarily want to leave your portfolio that unattended. Maybe check in every 5 years is fine, but check every year or so to see if you need to rebalance, and that should be a good enough compromise there. So to stick with things over the long term, really set up good processes, write things down. So as you're setting up your portfolio, write down what you're picking and why you're picking it, because a couple of years from now, it's going to be hard to remember why you chose what you chose. And having those notes is really going to help you stick to that plan when you remember why it is that you chose what you chose. Schedule things in your calendar, when you want to rebalance, when you want to check in on your plan, when you need to increase your contributions. And remember that good enough solutions are good enough. So you don't have to go for the lowest fee, most complex portfolio. Get what's good enough for you. So if you think that the TDE series is a better option for you than going with Questrade and a number of ETFs, then go with that for you. If you think a robo-advisor is going to provide value for you, go with that, even if it is going to cost a little bit more, as long as it helps you stick to what you need to do over the long term and helps you with automating. So thanks for listening into this and watching. For more from me, you can see these various links here, and I'll put the links in the bottom there. I just want to mention that I do have the course available, the Practical Index Investing for Canadians course. So you've seen the material here. This ran for about an hour. This was designed to be a presentation given in person at the Toronto Public Library. With time for questions, this whole thing would have run about 90 minutes. The course is an online self-paced course, so it includes a lot of this information, but in much more detail, so that it would be probably about 12 hours or so if you were to burn through it on a weekend. So you see there is more to learn here. We've done a big overview. This was designed to be self-contained so that if people wanted to come in and watch it at the library, they could without it being a big sales pitch for the course. But as long as we're here on YouTube, let's talk about it a little bit. So we'll have all the information there about how to do that step-by-step, a little bit slower with some more detail than trying to buzz through it rather quickly as we did here. But nonetheless, you did get to see how you actually make those purchases with TD and to see that it's not all that intimidating to do it yourself. And then the course will also have how to do that for Tangerine options, as well as how to do it for buying ETFs, whether you want to buy one ETF or a set of them. And then, of course, more information on those processes and those tips, like using your calendar, checking less often, etc. And then tools such as spreadsheets to track your cost basis for tax purposes, the information you need to understand how investments are taxed and what to do if you do have a non-registered account, as well as more information on those TFSAs, RRSPs, our ESPs, our DSPs, the things that we skipped over in this presentation, etc., etc. In my opinion, it's a lot of value. People who have taken it have been pretty happy with it. And if you think about paying that 2.5%, if you've got several tens of thousands or even hundreds of thousands of dollars, and it's taking you time, if you've been looking at this presentation, number of books, number of articles online, and it's taking you several weeks to get ready and to build up the confidence to start investing on your own, if that course can help kickstart you from moving over from paying high fees to having the confidence to do it yourself, remember, it only takes a couple of weeks earlier to save hundreds of dollars. So the course will totally pay for itself if you've got a few $100,000 invested, and you get investing faster with the course by just even a couple of weeks. And if you have been sitting here for several months trying to figure out how to invest, which unfortunately I know a lot of people have been, again, even with only a few tens of thousands of dollars, getting invested that much sooner, the course would have paid for itself already. Anyway, it is not necessarily for everyone. If this was all you needed, that was what it was designed to be. It was designed to be standalone, and I hope you enjoyed it. And for those of you in your family who you think might need it, do feel free to point them toward that course. And thanks again for your attention, and apologies for not breaking this up into 5-minute snazzy videos with slide whistles and sound effects and green screens, but this is what I've got for you.